Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, November 2nd, 2021. Stock markets are quite fine today, yet again. We're seeing another day, another rally, no turnaround Tuesday, at least so far. Not even for Tesla, which, having gained about, some call it 33, 38% over the last week or so, having on the Hertz news, announced that they don't actually have a signed contract with Hertz, and the stock is unchanged as I'm taping this, down maybe a point or 6 points or so, which is essentially unchanged. So, nothing to see here. We talked about this at length yesterday, and I'd recommend you take a look at the piece we wrote, which we'll get into it a lot more, and that is bond traders are getting nervous ahead of the Fed meeting. We saw it last night. I alluded to it yesterday, how Canada and Australia were two of the places that where people were getting among the most nervous. The RBA in Australia made its comments last night and kind of continued to freak people out. They're not doing yield curve control. I'd argue that at least in the short term, yield curve control is still going to be in place in the U.S., not at the long end or not even at the medium term as the Fed tapers. And I can't imagine at this point that they do anything other than announce a tapering of $15 billion a month to be done over the next 8 months, which would put us into mid next year. Because one thing we know about the Federal Reserve or Chairman Powell is they don't like to upset markets. So what also we see is in terms of yield curve control is remember what we've been saying about the reverse repo activity. Every day at the New York Fed, pretty much like clockwork, we're seeing somewhere between $1.3 and $1.5 trillion show up on a daily basis. Remember, these are rolled daily. On a daily basis, looking to get 5 basis points annualized worth of yield. Effectively, this is the Fed's way of not letting the short end of the curve go negative. Because what else are they doing? There's essentially seeing a year's worth of QE coming every day saying we've got nothing better to do with our money than hand it back to you at the Fed to try to get some measly rate of return. Otherwise, we would have to let it go negative because we just need this money off our books. That to me is the definition of a futile activity. And so, of course, I do give the Fed credit in understanding that what they're doing, they have to recognize this is silly. And so what I expect to see is they're going to cut back the tapering at a fairly quick rate. But again, because we know about their dual mandate of full employment and sustainable economic growth. But bottom line is they seem to have a triplicate mandate. Trying to think of the right word, tripartite mandate of keeping markets happy. And I think that they don't want a market accident. If for no other reason, they don't have a lot of ammunition to deal with a market accident, so they can't afford one. So I think what you're going to see is a Fed that doesn't disappoint the markets, that's going to keep pumping in money into the markets, except what tapering means is, it's been 120. When they start to taper, the next month it's going to be $105 billion worth of bonds they buy. Next month it's going to be $90 billion worth of bonds that they buy, et cetera, et cetera, et cetera. Can they accelerate the pace? Sure, but that again might involve freaking out the markets. Can they back off that if they need to? Yeah, sure. Nothing is etched in stone here. But I do start to think that bond traders are seeing the prospect of having their largest relentless, price-insensitive purchaser begin to exit the bond market, and that will cause some dislocation for bond prices. Stocks don't seem to care. That's the bottom line here. Serenity Now. I mean, we see it with the VIX around below 16 or around 16, which is essentially a fairly benign reading, especially in a week where you have a Fed meeting and a payroll number. We do see some anticipation of greater volatility further out, but not right now. You could argue, sure, why not? Of course, because of real interest rates are essentially negative because we have, I'm going to call it 3% inflation on average, and short-term rates that are being essentially manufactured to be around 0 or 5 basis points. Well, that's a pretty negative real yield. That inflates the TINA trade because there is no alternative. You could argue, negative if keeping your money in cash is going to cost you money in real terms. You could argue that that's a very punitive activity. And so why wouldn't you try to seek risk, or why wouldn't you take a flyer on non-yielding assets, which is why you're seeing the sort of appreciation that you do in very speculative stocks and in cryptocurrencies and the like. There's a logic to it. Markets, they seem irrational in many ways, but if you cut back down to it, that is the underlying rationale, and it's hard to dispute that. Now, should we be worried if the bond market? Should stock traders be worried if the bond market is worried? Yes, generally yes. Realize that bond traders have really no choice but to focus on inflationary expectations, Fed policy, monetary conditions, and the like. They don't have to worry about credit. The U.S. government is going to pay back its debts in one way or the other, unless, of course, we have a debt ceiling problem in December and decide to skip a payment or two. But let's avoid that situation for now. So they don't typically worry about credit. They don't typically worry that the stories don't mean anything to them. Does it matter that such and that Hertz is buying electric cars from Tesla? Does that have anything to do with the bond market, government bond markets, particularly on the short end? No. So they're very tightly focused on monetary conditions and inflationary expectations. And so if they're starting to worry about these things, maybe stock traders should at least consider them. It's tough right now that you don't want to consider anything other than a rising stock market and stocks that relentlessly go higher. Also, seasonality is in your favor in the stock market. There's a long history of markets performing well in November and December. And so what I'm going to call today is Serenity Now. It's the day before a Fed meeting. Volatility is low. Everybody seems happy yet again. And we'll see who's right, whether stock traders or bond traders are right. And truthfully, we may not know that tomorrow. We may just see the continuation of the pattern. Really depends on what Mr. Powell says. We'll talk about that more tomorrow. Take care. Bye-bye.